We're getting a slew of earnings results once again. Canadian Natural narrowly beat profit estimates. The production hit a record, though, and our own parent company, BCE, reported a profit that at least beat expectations. Let's get more from Ryan Bushell, CEO and Portfolio Manager at Newhaven Asset Management. Ryan, great to see you. Talk first about BCE. Did anything jump out for you in this quarter?
Yeah, thanks, Andy. Good to see you as well. Not really. You know, expectations get down far enough, and just some contribution from this U.S. business is nice to see. We've got a long way to go, but I would say, you know, generally the stock, if you look at the chart, is sort of exhibiting a nice kind of bottoming pattern here over the last 6 months, and hopefully better days ahead. You know, I continue to think that this is a much more valuable company than teachers offered to buy for $40 in 2008. A lot more infrastructure in the ground and in the wireless network as well. So just sort of a matter of time and management kind of circling the wagons.
I mean, overall in earnings season so far, has a theme emerged for you, Ryan?
You know, it's been strong. It's been stronger than I think most people would have expected, and that's really what's carried the market through October. U.S. tech earnings, despite continued huge spending announcements. Other than Meta, the market has kind of looked through those and actually looked positively on those. I wonder how much longer that will be the case, that they will continue to sort of extend credit without seeing return. So that's definitely a question mark, but with that earnings season largely past, we're through that. And now we're getting a slew of Canadian oil and gas results, which are looking pretty darn positive despite, you know, a pretty subdued pricing environment. And it kind of speaks to how the shares have been performing. The last time crude dropped below $60, or the last few times it's dropped below $60, you've seen pretty negative share price reactions in the Canadian oil and gas space. Not so this time. So, you know, they haven't been extremely positive, but they've been holding in nicely, and I think it speaks to a longer-term trend emerging.
What about the oil and gas business generally? Are you interested in nat gas stocks or oil stocks these days?
You know, primarily we've been talking a lot about natural gas, and I would say we were talking about that before. Now the market is kind of, more people are now talking about it. I'm actually more positive on getting more positive on oil by the day here. If you look at the OPEC capacity adds, we're through the great bulk of those. I think maybe sort of 700,000 barrels a day that could come on from Saudi Arabia. And again, those are announcements. Those aren't necessarily actual production. Russia continues to struggle under the weight of sanctions and attacks on their energy infrastructure. U.S. shale is the real question mark. With oil at $60, I don't see a ton of drilling happening. We will see, you know, over the next couple of months, we'll see CapEx plans announced. I think those will be pretty subdued, especially in the U.S. So for Canadian oil and gas stocks with those long-tailed resources and potentially now a more accommodative government policy backdrop, you know, I think you not only could see positive outcomes there in terms of both the commodity price and production adds, but I think really just from a sentiment point of view as well. And again, I think that's what you're seeing trend-wise in the stocks lately, why they've held up so well.
So you say you are defensive, though, broadly. Yeah, you've got big weightings in financials and utilities. One thing, TransAlta, I'm not sure if you've had any time to look at the TransAlta numbers today, Ryan, but the stock TA, speaking of electrical stocks, down sharply. The CEO is retiring, and it looks like the earnings disappointed investors.
Yeah, so we don't own TransAlta, and the reason is that we're not looking to play, you know, concentrated AI bets. So TransAlta and Capital Power to some extent have seen their share prices whipped around by announcements regarding data centers in Alberta. And those are going to be slower to develop, especially. It makes all kinds of sense economically. And you know, we've got the energy, we've got cooler climate, we've got space to build these things, but politically is the will there to make a 30, 40, 50-year investment on the other side of the border with all that's going on? I'm not sure. So you're seeing the share price kind of whipped around by that. So it's just giving back the big rise it had in October, with some of the hype around the data center announcements. The fundamentals for the company, I think, are relatively okay, but not great. So they wouldn't have justified that rise from $13 to $23 over the course of the year. Now you're just seeing them give that back. We're more interested in the larger in-place utilities, the Fortises, the Emiras, that are going to see, we think, just steady incremental growth over a longer period of time.
And you have a smallish weight in gold. What's your feeling? You want to still have a toe in the water there?
Yeah, and I always say I'd rather not own it. Gold and gold performing is usually a sign that there are problems. But coming out of 2021, 2022, just with the outsized stimulus that came into the market and just sort of what we saw happening, we thought it was wise to take a position, and we just sort of bought the largest, most liquid player in Canada, being Agnico Eagle, and that's done well. But yeah, we're not adding at these levels. But at the same time, on any sort of material pullback, if gold got back to 3,500 or below, I think we'd be, for new clients, not existing clients have their weight and it's been a quadruple, so that's fine. But other clients that don't own it yet, we would probably still look to stay invested there.
Ryan, thank you very much indeed.
Thanks, Andy.
Ryan Bushell, CEO and Portfolio Manager at Newhaven Asset Management.